Hey everyone, welcome back. We're going to be tackling something today that I'm sure a lot of you are interested in. And that is how to invest when the market feels like a roller coaster.
Yeah.
You know, those stomach-churning drops and the
Yeah.
dizzying climbs?
Sure.
Well, get this. We're going to be exploring a strategy from investing in volatile markets. A two-basket strategy that claims you can actually ride those market waves without constantly buying and selling.
It's a fascinating concept
Oh, okay.
because instead of just reacting to the volatility, you're using a system to potentially turn it to your advantage.
Okay, I am so intrigued.
Yeah.
So tell me, what's the big idea here?
Well, the core concept is deceptively simple.
Okay.
You divide your portfolio into two baskets.
Okay.
One basket is all about stability, what the author calls your strong assets.
Mm-hmm.
The other basket is dedicated to assets with higher volatility, but also higher growth potential.
So it's kind of like having a checking account for your everyday expenses and then a separate investment account for long-term growth.
That's a great analogy. The stable basket acts as your foundation, a source of capital that you can rely on even when the market gets turbulent.
Makes sense.
Hmm.
Now, the source material specifically mentioned Bitcoin and something called JLP for this stable basket,
Right.
Bitcoin.stable.
Yeah.
Didn't the price of that thing drop like a rock last year?
You're absolutely right. Bitcoin is known for its price swings.
Yeah.
But remember, we're talking about relative stability within the crypto world.
Okay.
Bitcoin, especially when you look at it over the long term, has actually held its value quite well compared to many other cryptocurrencies.
Okay, so it's all relative.
Exactly.
But what about this JLP?
Yeah.
I have to admit, I'm not familiar with that one.
JLP stands for Jupiter Liquidity Pools.
Okay.
It's a way to earn passive income by providing liquidity on the Jupiter Decentralized Exchange, which operates on the Solana blockchain.
Okay.
Think of it like lending your money out and earning interest.
Okay.
Except in this case, you're lending out your crypto assets.
Right. Ah, okay. That makes more sense.
Yeah.
But why are Bitcoin and JLP considered so strong in this context?
Well, the source highlights three main reasons.
Okay.
First, they tend to hold their value better during market dips.
Okay.
Think of it like having an anchor that helps steady your portfolio during a storm.
Right.
Second, they offer liquidity and flexibility.
Mm-hmm.
This means you can easily convert them to cash
Right.
or move them into other assets if needed. It's like having an emergency fund that's always accessible.
Right. And the third reason?
The third reason is their long-term growth potential.
Mm-hmm.
While they may not experience the same dramatic price spikes
Right.
as some of the more volatile assets, they're expected to appreciate steadily over time.
So it's like having a slow and steady tortoise in the race.
Yeah.
While we also have a hare in the other basket.
Exactly.
Speaking of which, let's switch gears and talk about those exciting high growth opportunities.
Yeah.
The volatile assets basket.
Right.
What's the author's take on those?
This is where things get really interesting.
Okay.
We're talking about assets with the potential for explosive growth,
Uh-huh.
but also higher risk.
Okay.
The author specifically mentions Solana,
Mhm.
SUI, and other emerging blockchain technologies as examples.
Okay.
These are the hares of the portfolio,
Yeah.
the ones that could potentially make you big returns, but also carry the risk of bigger losses.
Okay. So we've got our anchor assets in one basket and our high growth, potentially risky assets in the other.
Exactly.
But how do we decide how much to put in each? Is there a magic formula?
There's no one-size-fits-all answer,
Okay.
as it depends on your individual risk tolerance and investment goals.
Okay.
However, the author suggests allocating a smaller percentage of your overall portfolio
Okay.
to the volatile basket to manage that risk.
Right. Wouldn't want to put all our eggs in that potentially wobbly basket.
Yeah, exactly.
But here's the thing. How do you actually move money between these baskets without trying to time the market perfectly?
Yep.
I mean, none of us have a crystal ball to predict when those peaks and valleys are going to hit.
That's where the concept of dollar cost averaging, or DCA, comes in.
Okay.
This is a strategy that's particularly well suited for volatile markets.
DCA.
Yeah.
I've heard that term thrown around a lot.
Right.
But to be honest, I'm still a little fuzzy on exactly how it works.
Okay.
Could you break it down for me and our listeners
Sure.
in simple terms?
Absolutely. Imagine you're at the market buying apples.
Okay.
Instead of buying a whole bag when the price is high,
Mm-hmm.
you decide to buy a few apples each week,
Okay.
regardless of the price.
Okay.
Some weeks you'll pay a little more,
Mm-hmm.
Some weeks you'll pay a little less,
Right.
but over time,
Yeah.
you end up with a bag of apples at a good average price.
That's a great way to explain it.
Yeah,
So instead of trying to perfectly time the market,
exactly.
you're essentially spreading out your purchases over time,
Right.
which helps to reduce the impact of those price fluctuations.
Yeah.
And that's the beauty of DCA.
Yeah.
It helps you avoid buying high and selling low,
Right.
which is a common mistake that investors make when they try to time the market.
For sure.
Okay, this is starting to make a lot of sense.
Okay.
But how does DCA actually work in the context of this two-basket approach?
Mm-hmm.
How do we know when to move money from one basket to the other?
Great question. Let's say the market takes a dip
Ooh.
and those volatile assets suddenly look a lot cheaper.
Yeah.
That would be your cue to start moving some funds from your stable basket,
Okay.
those Bitcoin and JLP holdings,
Mm-hmm.
into your volatile basket,
Okay.
picking up those Solana or SUI assets at a potentially discounted price.
Okay.
But you wouldn't do this all at once.
So we're not trying to perfectly catch the bottom of the dip.
Right. Instead of trying to time it perfectly,
Yeah.
you'd use DCA to spread out those purchases over a period of time, let's say
Mhm.
a month.
Okay.
That way, you're ensuring you get a good average price, even if the market continues to fluctuate.
Got it. So we're riding the wave down,
Yeah.
gradually accumulating those assets using DCA.
Mm-hmm.
But what about the flip side?
Right.
When our volatile assets have done their thing
Yeah.
and made some nice gains,
Yeah.
how do we bring those profits back to the stable side?
You use the same principle.
Okay.
Let's say one of your volatile picks has gone up significantly.
Okay.
Instead of selling everything at once
Right.
and potentially missing out on further gains,
Mm-hmm.
you'd use DCA again, this
Okay.
time to gradually sell portions of that asset
Okay.
and move those funds back into your stable basket.
So instead of trying to time the top perfectly,
Exactly.
we're gradually locking in those profits as the asset rises.
Precisely. It's about taking emotion out of the equation and
Right.
sticking to a disciplined approach,
Yeah.
whether the market is going up or down.
This system sounds amazing,
Yeah.
but I have to ask, is it really that simple?
Well,
I feel like there must be a catch.
there is one crucial element we haven't discussed yet,
Go
and
ahead.
it's arguably the most important of all.
Okay.
The author repeatedly emphasizes that this two-basket approach, combined with DCA,
Mm-hmm.
requires a certain mindset.
You're talking about patience and discipline,
Yes,
right?
exactly.
It's about playing the long game,
Yeah,
not trying to
it's-
get rich quick.
Exactly. It's about having the patience to ride out those inevitable market swings and the discipline to stick to your strategy even when things get tempting or a little scary.
Yeah, you hear all these stories about people making a killing in the market
Right.
by perfectly timing their trades.
Right.
But I imagine for every one of those stories, there are countless others of people who lost big trying to do the same.
You're absolutely right. Trying to time the market is a bit like trying to catch lightning in a bottle.
Right.
It's incredibly difficult, and the odds of success are slim.
So this two-basket approach, combined with DCA,
Right.
is almost like an antidote to that impulsive get-rich-quick mentality that seems to dominate the investment world.
Absolutely. It's about creating a system that takes emotion out of the equation and allows you to make rational decisions based on a well-defined strategy.
Okay, I'm sold, but let's say I've got my two baskets set up.
Mm-hmm.
I'm diligently using DCA,
Right.
and I'm mentally prepared for the long haul.
Okay.
What kind of results can I realistically expect?
Yeah.
The source material must have some insights on that.
Well, the author doesn't make any specific promises about returns,
Okay.
which is always a good sign in my book. Anyone who guarantees you a certain return in the investment world is probably trying to sell you something.
Good point. So what does the author emphasize instead?
The author emphasizes the importance of consistency and patience.
Oh.
They even have a great quote.
Okay.
The patient investor always has the capital to take advantage of the best opportunities.
Ooh.
It's like they're always ready for that next wave, no matter what the market throws their way.
I love that. It's like they're surfing the market instead of getting tossed around by it.
Right?
So even though there are no guarantees, it sounds like the main benefit here is peace of mind. Knowing that you have a plan, a system that you trust,
Right.
and that you're not constantly reacting to every little market blip.
That's a great way to put it. It's about taking control of your investments instead of letting your investments control you.
This is so refreshing. It's so easy to get caught up in the hype, to feel like you need to be constantly buying and selling to beat the market. But this approach is almost like a Zen garden in the middle of a hurricane.
That's a beautiful way to put it. It's about finding that sense of calm amidst the chaos.
So to recap, we have our two baskets, the stable basket with Bitcoin and JLP,
Mm-hmm.
and the volatile basket with assets like Solana and SUI.
Right?
We move between these baskets using DCA,
Yeah.
buying into volatile assets during dips,
Yeah.
and selling portions back to the stable basket after gains.
Exactly.
And most importantly, we cultivate patience and discipline as our guiding principles.
Absolutely.
It sounds like a pretty solid framework for navigating the choppy waters of the market, wouldn't you say?
I absolutely agree. And you know what's particularly interesting to me is that this approach can be applied beyond just crypto.
Oh, okay.
It's a mindset, a way of thinking about risk and reward that can be adapted to other areas of your financial life and perhaps even beyond.
Ooh, that's a thought-provoking idea.
Yeah.
So it's not just about the specific assets, but about this broader philosophy of having a solid foundation, taking calculated risks, and not letting emotions drive your decisions.
Exactly. It's like a mental model that you can apply to different situations.
This is getting me really excited.
Yeah.
I'm already starting to think about how I could apply this two-basket thinking to other areas of my finances, maybe even to my savings goals.
Yeah.
For example, a portion of my savings goes into a high-yield savings account for easy access, and another portion goes into a long-term investment account for growth.
That's a great example. And you can even take it a step further and think about how you could apply these principles to your career, your relationships, even your personal development. Where are you playing it safe and where are you taking calculated risks?
Wow, this is blowing my mind. I hadn't even thought about it in those terms before. It's like the author has given us a new lens through which to view the world.
And that's the power of learning, isn't it? It's not just about acquiring information, it's about expanding your perspective and opening up new possibilities.
Okay, so we've covered a lot of ground here,
Yeah.
from the nitty-gritty of DCA to the philosophical implications of this two-basket approach.
Right.
But if our listener were to walk away with just one key takeaway,
Mm-hmm.
what would you say it should be?
I think the biggest takeaway is this: you don't have to be a financial guru or have insider information to navigate volatile markets.
Right.
By adopting this two-basket approach combined with the power of DCA,
Yeah.
you can create a system that helps you manage risk, promote steady growth, and most importantly, sleep soundly at night knowing you have a plan in place.
That's a great point. It's about empowering yourself to make informed decisions and not letting fear or greed dictate your actions.
Exactly. It's about taking control of your financial journey and creating a future where you feel both secure and excited about the possibilities.
It's like that feeling you get when you finally organize a messy closet,
Yeah.
like a sense of order and control.
Yes. And just like organizing a closet, this approach can bring a sense of clarity and confidence to your financial life.
I love how this conversation has gone beyond just investing in crypto.
Yeah.
It feels like we've stumbled onto a universal framework for decision-making in so many areas of life.
That's what's so exciting about exploring these concepts. You start with a specific strategy, but it ends up sparking all sorts of connections and new ways of thinking.
So as we wrap up this deep dive,
Okay.
I have one final thought to leave our listener with.
Okay.
Imagine taking this two-basket system
Yeah.
and applying it to an area of your life where you crave more stability, but also want to leave room for growth.
That's a brilliant challenge. What would those two baskets represent for you? And how could you use the principle of DCA,
Right.
those small, consistent actions over time, to navigate the inevitable ups and downs?
It's a powerful question to ponder, isn't it?
It is.
It could be your career, your relationships, your health, your creative pursuits.
Mm-hmm.
The possibilities are endless.
Exactly. It's about identifying those areas where you might be playing it too safe, or conversely, where you might be taking on too much risk without a solid foundation.
And then it's about finding that sweet spot, that balance between stability and growth,
Mm-hmm.
using this two-basket approach as a guide.
Beautifully said. Because ultimately, it's not just about managing our money.
Right.
It's about designing a life that feels both grounded and expansive.
Well said.
Yeah.
And on that note, we'll leave you to explore those possibilities. Until next time, keep those minds curious. And remember, even in the midst of volatility, there's always a path forward.